You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.
And now, it's time for the show that breaks down the options market. From unusual activity alerts to market updates and trading strategies. If it involves puts and calls, then our all-star panel will break it down. It's time to hit the option block with your host, Mark Longo from theoptionsinsider.com, and co-hosts, Uncle Mike Tosaw from RCM Asset Management, Andrew the Rock Lobster Giovinazzi, and Mark the Greasy Meatball Sebastian from OptionPit.com.
All right, everybody. That rockin' tune means it's time once again for the Option Block, everyone's favorite bi-weekly source for all things options related. My name is Mark Longo, coming to you from the Options Insider Radio Network studios in a lovely, some may say even a balmy, Chicago, Illinois here, the options capital of the world. A nice balmy 55 or so degrees outside, which is, if you've been to Chicago this time of year, a bit unseasonable. So we're making the best of it here. And of course, here at the old network, we put out a lot of fine programming that you can find in many different locales and tools and venues and platforms, including, of course, our website, our online portal, theoptionsinsider.com. Surf on over there if you got some time on your hands during the day, after the close, before the open, middle of the night. We don't care when you surf over. We love to have you guys there 24/7. While you're there, you can find, of course, breaking news from the options market, a lot of great educational and analytical articles from the world of options, as well as, of course, that one click, that one tab full of all of our radio goodness for the past coming up on 9 years. Yes, you heard me correctly. 9 years worth of options audio goodness coming at you from that one tab. You can download or stream till your heart's content. And if that's not enough for you, if you want to get on other platforms, well, we're available there too, including iTunes, TuneIn, Stitcher, etc., all the way down to our own mobile app, available pretty much for all platforms except Windows Mobile. You guys are the one glaring exception out there. So all 6 of you out there rocking a Nokia device or a Microsoft relabeled Nokia device, then by all means, I apologize, but we've got enough alternative ways for you guys to find the program. So check it out. And of course, while you're listening, while you're downloading, while you're streaming, send us your questions, your comments, your insights, your hilarious pearls of wisdom. We love to hear from you guys. All right. And joining me on the old program today, beaming in, first off, not from the hinterlands of Maine this time, nor even from the nearby down the street area of Chicago that he was in last week, but now we have not the Rock Lobster, but his cohort, the Greasy Meatball, beaming in from the, denizens, environs, call them what you will, of Detroit over there. Mr. Greasy Meatball, welcome to the program from that audio sanctum known as Detroit.
The suburbs of Detroit are actually gorgeous, and it's not like I'm hanging out in like an abandoned building doing the option block. All right, so but yeah, good to be here. My father-in-law and I went and saw the Force Awakens this morning, and we were pleased. So who wants spoilers?
I can think of one or two big ones. I did see it myself. It is a fun film. Maybe before we even get into the full spoiler-ridden reviews on the program, so listeners, cover your ears. First, we'll welcome in our other cohort here, Uncle Mike Tosaw. Welcome to the program, A, Uncle Mike, and B, did you have a chance to take in The Force Awakens over the weekend?
The Force has not awakened as of yet with me, but...
all right, well then, we won't ruin it for you, but here's what I'll say about it is... If you really liked the first 3 movies and then thought the second 3, the prequel, stunk, this movie will make you happy. That's all I'll say.
Yeah, it is nice. They kind of ignored the fact that those movies existed. There's not a single reference, not a single real character, not a single real any allusion to those movies whatsoever. And I've been saying for a long time that Lucas made a cool sandbox. Now he needs to step back and let some other kids play in it, and that's pretty much exactly what they did with this new film. It's all the things you love and remember from the old ones: Millennium Falcon, Han and Chewie, X-Wings, TIE Fighters, Death Star, the whole 9 yards. A super mega Death Star this time, in case you were tired of the other two paltry Death Stars. They got a mega one for you that channels the sun and launches it as some sort of weapon. So all sorts of fun stuff going on there, including some dubious moments that I won't describe here, but ones that I think will make some old school fans a wee bit sad. Let's just leave it there. But it was good stuff. My little guy's first ever attempt to take in a Star Wars live in the theater. So that was fun. A big moment in the father-son relationship there, taking your little guy to Star Wars for the first time on the big screen. Always fun stuff. And speaking of Star Wars and all things Disney related, let's just get right into it and dive right on into the trading block.
It's time to break down the latest topics, trades, and trends in the world of options. It's time for the Trading Block.
All right, everybody, welcome to the Trading Block. This is indeed the portion of the program where we break down what was lighting it up in today's activity, and it was a bit of an upside day on the street. Most of the major indices closing up about 0.5% or more on the day, and of course, good old VIX cash as a result, giving up some of that nice juicy premium it had built up over the past week, closing right around 19, a little over the 19 handle today. So south of the 20 handle, getting close to that range. I was in, I think I said the 18 to 19 handle on vol views. You were about 16. You were the dire pessimist from a vol perspective, Mark. So we're closing in on that. We'll see how that shapes up toward the end of the week. Russell looking ever the more distant with his, I believe he said mid-20 range again. So he's a little bit far north from here, but a lot of stuff lighting it off today. I think we'll start as we were delving into the realm of Disney. I think you could say, despite the movie just lighting it up, doing, I think, 500 plus million or so internationally, and that's without China even coming on the scene. So the movie just printing money. We have yet another one of those buy the rumor, sell the fact kind of deals where Disney stock pretty much taking it on the chin ever since the movie debuted last Thursday. It's off nearly 10 handles since then. Even on a day like today with the market rallying, Disney still selling off about 1.5% on the day. So a lot of people liking the movie, liking the numbers it's making for Disney, yet not enough to actually buy the stock, dumping it off, like I said, closing today about 106 and a quarter or so. So the name has been pretty active from an options perspective as well since the Force Awakened. I almost said the Force Unleashed. The Force Awakened in the box office there. It's been averaging about 64,000 contracts a day, doing about 2x that, about 130,000 contracts today. So been interesting one to watch. The investing public perhaps not smiling on the Force. So Mr. Sebastian, any last thoughts there on the movie as well as its collateral damage here on Disney stock?
Yeah, it was definitely down. However, I think it's probably, we were looking at some areas where one could sell puts or do a ratio put spread or something like that as a way to get in. They've juiced the vol up a little bit, and it looks like it's starting to get pretty cheap. Now, I want to make a comment on VIX and VIX futures and how spectacular, how kind of uninspiring today's rally is, and how spectacular the vol sell-off was. So, Mark, on Thursday and Friday, we saw the market. On Thursday, we gave away 31 handles, and the VIX rallied. The Jan future went from about 1785 to 1930. All right. So then on Friday, we sold off 36 handles, and the Jan future goes from 1930 to 2047. Today, we rally 15 handles, so we make up roughly 25% of what we've given away. And the VIX future is now trading 19. It's off $1.45. So we've not only given away all of the gain from Friday, we've actually given away part of the gain from Thursday. So they are, if there was any doubt that they're going to come in and try and obliterate this stuff, let this doubt be broken. They are coming for this stuff, and they intend to blast this stuff. So I think this is just the beginning. And assuming we get a similar day to today, or maybe even a stronger up day tomorrow, you could see them really, really finally say, it's the holiday season and VIX is down. I'm selling Primo with both palms out. It's the selling Primo down. So that's what I think is going to happen.
We're getting to that special time of year when Mark is inclined to sing yet again here on the program. But you're right, they are kind of crushing it. And this was kind of the debate we were having on some programs last week, because there wasn't a lot looking to the future that would really foretell a lot of vol coming back into the markets post-Fed. Seemed like Fed was kind of the last big event on the horizon, and then they were free to kind of smash it post-Fed. And we saw that didn't really play out immediately post-Fed. We saw, like we said, VIX catching a bid, market selling off a bit. We saw, of course, some of that vol creeping back in, and then post this weekend, perhaps digesting all that information and market rallying again today, despite all the other things going on with crude. That I guess they're content to say, the holidays are here, let's crush it. Which is interesting, because looking at some of the data, this is shaping up to actually be a pretty volatile December so far, the most volatile, in fact, since 2008, at least when you're looking at it through the lens of Dow Jones, specifically the Dow Jones Index. Of course, we had the big move down on Friday. We have yet another 100-handle move again today. The Dow closing up over 100 handles again today. So that means, including today, this was data from this morning. If you include today's move, it's actually more. The Dow's registered 12 days with moves of 100 or more points. Of course, this is close to close data. So from close to close, that's the most days with the moves of that size, essentially, since back in the rocking, rolling period of Dees 2008. And once you get beyond that, it really falls off a cliff. You have, December 2009, kind of with 4 total days, and it was 13 in 2008. Then it really kind of falls off a cliff from there. So yeah, this year with today locked into the pack actually is tied now with December of 2008. So crazy times here from a vol perspective in December, and yet people still not hesitant at all, as we just mentioned, to kind of come in and crush themselves, or use the more polite, euphemistic term, harvest themselves some premium here across the board going into the final weeks of the year. Uncle Mike, aside from all the Force Awakening, aside from this kind of VIX premium collapse and futures collapse and volatile Dow, all the other things kicking off, what really caught your eye in today's activity, sir?
I got the peppermint sticks for old St. VIX. Sorry, just had to add that one in there after Mark's rendition of it.
I didn't realize we had the singing show today. I would have brought my A game.
Well, it's old St. VIX. But anyway, no, today was just, I think, a lot of just taking back what was bringing back what was taken on Friday in the market in general, to kind of add to what Mark had said about with what's going on with the VIX. I think that with Friday being the down day like it was, a lot of times after a Fed announcement from the market in general, the market does need to digest it somewhat. And I think it was a little bit of, personally, I thought it was a little bit of an overreaction as to what happened on Friday, as well as Thursday for that matter, based on what the Fed was doing. And I do see a little bit of a Santa Claus rally coming in the near term on the S&P in general, but nothing too phenomenal over the next couple of weeks. But I do think that with the Fed doing what they did last week, that it was the right thing to do in terms of how they were very dovishly hawkish or hawkishly dovish, whatever way you want to describe it. They did finally raise rates, and so we can quit talking about such things, at least for the near term anyway. They left things open, and so it seems like the Fed is going to be somewhat, hopefully, out of the picture for a while. A little bit of a rally today on the gold side of it. And then in my beloved XLE, with which I'm telling everybody to buy, it seems, it actually was up 6 pennies on the day. Nice. Oil is still down. And with that, I still just want to reiterate my sentiment. I think now is going to be 5 years from now, we're going to look back and see that it would have been a great time to buy XLE or oil stocks in general.
Mike, I just wanted to let you know that I'm going to title today's blog post on optionpit.com Peppermint Stick for Old St. VIX, because that was so clever. Good work.
Thank you, sir.
There you go. His copyright check will be in the mail forthwith. But have you made, speaking of crude, of course, have you made any adjustments to that? Of course, we are seeing continued protracted sell-off out there in crude land. We have Brent, looking at it through the lens of Brent this time, down to about an 11-year low. Hasn't hit these levels, just flirting with the 36 handle today. Hasn't seen those levels since July of 2004. So Brent just taking it on the chin, and of course WTI following suit as well, as Saudi Arabia and a lot of the other countries, Russia and others, continue to just crank out as much oil as they possibly can, regardless of what the end price of that is. Hey, you know, they'll make it up in volume on the back end, what they lose in price, I suppose. But still, a lot of interesting stuff cooking off out there, and so crude continues to take a beating. I know you came out with the big bullish position, the bullish statement on crude last show. Uncle Mike, have you made any position revisions since then, or any adjustments, or what's the outlook going forward here?
No, I mean, a lot of people, when I did that, XLE was around the 60 level. When I started to buy a little bit more of it, it's at 58.85 at this stage. For the people with whom I'm buying it in their accounts, it's a smaller section of their portfolio. And so, no, to answer your question, have not as of this stage. If we have a warm winter, I think it could be a little bit more, there could be a little bit more of a downturn in it, just because of the fact that there'll be so little demand for natural gas or anything along those lines, combined with the fact that OPEC is, as you say, cranking out as much as they possibly can. But at some point, something's got to give. And I have a hard time believing we're going to be allowed to be paying $1.50 or $1.60 or whatever it is. And well, you guys live in Chicago, so the price there is probably still down to about $8 a gallon there. Who knows? But anyway, I have a hard time believing that that's going to last for a long time. I think that oil companies are going to find a way with which to bring the price up in some way, shape, or form.
So straight up buys of XLE, then that's how it's riding on. Any downside puts? I know you love those 30 handle puts for so long in XLE, right? In any of those these days?
Nope. The way it's going, I might be writing some pretty soon.
Yeah, those may be in play pretty soon. Who knows?
Yeah, we made fun of that for so much. But no, I think just straight buying XLE at this point in time, not with a large section of your portfolio, but just with a little bit, sit on it for a while. And in the meantime, as we've said on this show a lot before, you're getting a dividend by the lesser amount of money that you pay at the pump.
Yeah, I mean, it's that natural hedge. We're all short crude at the end of the day. Mark, I know you tend to prefer USO. Is that pretty much, if you had to make, or if you had to advise a client right now who came to you saying, hey, I want to get long-term bullish, me some black Texas tea there, what's your favorite longer-term play for crude?
I mean, I would play ExxonMobil or something like that as opposed to USO. USO just underperforms. I like Mike's idea for XLE, actually, as opposed. But, you know, obviously, I think ExxonMobil or Chevron, Texaco, or Conoco, I would probably go with a diversified global producer because, you know, if oil stays here for a while, you're going to get a dividend. You know, put it on a drip. Collect the dividend, and have it buying more stock as the stock moves around, and then eventually, when oil picks up, you'll be a happy camper because you know at some point those are done.
Yeah, and buy the SUV and drive it around now, folks, because in a couple of years you won't want that 8 mile a gallon monstrosity anymore. Speaking, you mentioned downtown Chicago, Uncle Mike. I paid $1.86 in downtown Chicago the other day, so that is impressive. That just blew my mind when I did that. I don't think it has been south of $2 since my little guy was born. It's been quite a while. So to see it $1.86 in the height of an area where people actually live is a pretty crazy thing. Mark, you mentioned before the underperformance of USO. That's a much maligned entity here on this program, but another name that is a very recent addition to that underperformance category was your former stalwart holding, Uncle Mike, now turned perhaps a rotten apple. That is indeed the Big Apple. The name just continues to take it on the chin. Not so much today, up about 1% or so with the broad market, finally getting a rally day out there. But overall, this month of December, I mentioned the volatility out there, has also not been a great month for the big fruit company out there. Of course, hit its peak back in April, right around around the 134.5 range. It was up 22% on the year at that time. And now, depending on where you look at it now, it's somewhere down around 4% or so for the year. So from up 22% to down 4% in the latter half of this year has not been essentially the best time. Of course, we've debated quite a bit the people coming in saying this name is going to underperform. We're also seeing a lot of the suppliers now, which is starting to weigh on the name, saying, yeah, we're actually scheduled to ship fewer screens and fewer other parts to them, which is kind of an acknowledgement of the fact of their reduced demand. They're also on that S cycle, which is kind of the less exciting of the two. It's kind of the mid-range cycle as opposed to the big revisions that come on every other year. So there's a lot of things combining to weigh on Apple. Like I said, hovering right around the 107 handle here today. Uncle Mike, I know you were waiting with that Uncle Mike Innovation Index, the UMII. You were waiting for that to flip for a level for you to dive back in. Has any of this price action in Apple caused you to change that at all? Are you still pretty much waiting and seeing out here in Apple land?
No, but I have to say it is mighty tempting at these levels, I will admit. But do I see Apple going to 200 or anything like that? No, I really don't in the near term, unless they do come up with something innovative. But this is looking mighty tempting to start selling some puts on and just trading it like a wheel stock, I have to admit.
I don't disagree at that level. I mean, at a certain point, they have so much cash that it starts to look interesting. But, what I think people need to recognize is that they are not this, impervious force of marketing. Nobody bought the watch. They've got an absolute grand slam product, which is the phone. They've got a home run product in the iPad that is now more of a rounding second ground rule double. They've got a single in all of their computer stuff, and Apple Pay is ubiquitous with PayPal, Google Pay, Amazon Pay, PayPay, you name it. And really, the watch is ugly, and nobody's wearing it. So, they don't have, they haven't had a real home run product in 5 years. Anything innovative. They're not. What they're doing now is crowding out the phone marketplace, and that is it. They're about and at what point do they start getting regulatory crackdowns from the government because they own too much of the phone market?
I don't know. Android may be helping with them with that as they continue to erode some of their share, and of course things like the recent Apple iPhone charger case, which don't have the hallmarks of Apple's historic design, are perhaps going a long way to show that this is a different Apple company. Of course, the Apple zealots will write in. If you have different contrarian or contrasting opinions, let us know. We'd love to hear from you guys here in the mail block. Meanwhile, it's time for us to keep on rolling into my personal favorite segment, except, of course, for your listener questions, and that is indeed the Odd Block.
It's time to break down the most interesting, unusual, and downright questionable options activity that's been identified by theoptionsinsider.com. It's time for the Odd Block.
Everybody, welcome to the Odd Block. Like the name implies, this is the portion of the show where we put on our sleuthin' attire, grab our magnifying glasses, and start following those clues to the dubious, the shadier, the more just downright unseemly paper that is lighting up the options market today. Going to kick things off in a name. It's been a frequent offender this year. Haven't talked about it in a little while, but it's back on the hot seat. This is our old friend EWZ. This is the iShares MSCI Brazil Index ETF. Closing today, $20.74, off about a quarter, which is about 1% or so in this name. And this is the name that does some paper, as you might imagine, from its previous appearances here on the program. And today it did some paper and then some. This name does about 100,000 contracts a day, doing 663,000 contracts. That is VIX paper, ladies and gentlemen. That is Apple paper. That is size paper, however you want to carve it out. So somebody came for this one today in a big way, and also for some big size, just tons of size. Big size going up across the board in a lot of months. What really caught our eye, though, was a little bit farther down the expiration cycle all the way out to June. In particular, what started off catching our eye was a size call three-way to the tune of the June 23, 30, 35 call spread, call fly, call it what you will, going up 62,540 times by 156,000 times by 78,150, all the way up there on the June 35 strike. And if that wasn't enough, listeners, also we saw some put love going up. In particular, it was the June 24-18, another funky wide strike selection here, going up 1 by 2, 30, or roughly 1 by 2, 35,000 by about 60,000 on the downside there. So a lot of interesting stuff afoot here. It looks like, given the OI numbers, that the 23, 30, 35 call fly is probably closing because it lines up pretty close with those OI numbers, about 68,000, 195,000, and 84,000 respectively open on those strikes. On the put 1 by 2, it looks like our friend there may be rolling down to a little bit more judicious strike. There's about 35,000 exactly open on the 24 puts and only 19 open on the 18 puts, excuse me. So a lot of paper going off over here. Mark, I know you've been sinking your teeth into this one all day. Walk us through your thoughts on this probably closing call fly, and then perhaps opening put 1 by 2 here in EWZ, counting for hundreds of thousands of contracts in these two trades.
I mean, that's just a crazy trade. The EWZ was definitely a close, for sure. There's no way the volume just matches up too perfectly. And then in this FAS, that one was unique. I'm not exactly sure exactly what they're thinking, but one of the nice things about doing these 1 by 2s and these weird, crazy, ETFs is that rolling stuff can really work to your favor. So if they do sit, they can collapse relatively quickly. That one both pretty unique. The DWZ definitely a close, and then the FAS was an open and probably more of a play on vol and lack of movement. That's kind of my bet than actually a directional play.
Well, since you mentioned the FAS, let's get to that one here as well. That is indeed ticker symbol FAS. That's the Direxion Daily Financial Bull 3X shares. So if you're into the levered ETFs, we got one for you here today. This name closing $28.12, up about 71 cents or about 2.5% on the day. This is the name that does about 12,000 contracts a day, doing a little over 32,000, so nearly 3x there today. And as Mark alluded to, we saw some interesting paper out here as well. We saw put 1 by 2s were the order of the day in EWZ. Now we're looking at some call 1 by 2s in FAS. In particular, it was the Jan 27.5 31 call 1 by 2 that was lighting it up today. When we started watching this one, looks like one big block went up on Gemini, total on the day of about 7,300 of the Jan 27 halves and about nearly 16,000 of the Jan 31 calls. Size open interest on both of these strikes, about 19,000 on the Jan 27 halves and about 10,000 on the 31s. So as Mark alluded to earlier, this could indeed be a bit of a closing of the lower strike. Again, that was a 27.5, so those are a bit in the money now. Stock hovering over the 28 handle. Our friend perhaps deciding to roll to a far more OTM strike. In this case, the 31s to the tune of 15,000. Again, doing it about 7,500 by nearly 16,000 times. So perhaps closing on the 27 halves and opening there on the 31s. Did I put words in your mouth there, Mr. Sebastian? Or is that how you're feeling on this one as well?
Nope, you're 100% right.
I'm just going to bottle that and just cut that out and use that in every show. Because
lovely.
Because as we all know, it is indeed correct. As we move on to our final name, our final victim, our final celebutant, participant, to call them what you will here, on the old odd block. In particular, this is our old friend, haven't been back into this one in a while. This is Mosaic. No, not of ye old browser fame, the precursor to Netflix or any of that fun stuff. No, this is Mosaic Company, ticker symbol MOS. They make all sorts of phosphate and nutrients for fertilizers and things like that. So a far less sexy area of the space, but also not getting smiled upon by the street today, off about $1.30 or about 4.5%, closing at about 27 1/4. This is the name that does about 6,000 contracts a day and some change, doing nearly 40,000 to go here today. And what we saw here was the Jan 30s in particular that really caught my eye. The Jan 30s going up, when we first started watching them, only about 700 and change, going up here for about 85 cents. As the day went on, a lot more, to the tune of about 19,000 and some change, going up on this strike, and kind of a little bit of a back and forth tug of war. We saw some selling, some buying. We saw some bids coming in and just getting filled routinely throughout the day. So there were buyers out there, and they were getting filled, and they were getting met by sellers, clearly. But on the net, on the day, it seemed like the paper was mostly leaning towards the buys. About 13,000 contracts open on this strike, so clearly opening paper net here on the day. If you guys remember, back in late November, we also profiled some call buyers here on November 20th, actually. And so far, not exactly feeling the love out there. We also saw about 2,000 of the Jan 32 halves going up here on the day as well. So a lot of upside call love here, mostly buying in Jan. Mark, take us home with some call love here in the phosphate sector and Mosaic.
Well, you got to wonder whether they're either A, replacing a stock position that they're dumping, or B, straight up shorting the stock and hedging upside. Because this stock has been taken out to the woodshed the last few weeks. It's off almost 20%, maybe more. And, I mean, they are just destroying this thing. So call buying is either a hedge or maybe stock replacement for someone that couldn't take the heat anymore. All I know is, I look at that and I see it more as a play on volatility than as a play on the stock skyrocketing, because I just don't see it.
All right, that's going to do it for the old odd block today, and now it's time for us to keep on rolling into the strategy block.
It's time to dispense options wit, wisdom, and education. It's time for the strategy block.
All right, everybody, welcome to the strategy block. It's Monday. It's the time of the week. It's the time of the show where we welcome on Uncle Mike to put on his smoking jacket and grab his bubble pipe and perhaps some nice comfy slippers and those stone tablets he's so fond of, and sit down by a nice roaring fire, because it is that time of the year, even though it is about 55 degrees. We can just pretend one of those electric fires that don't shoot out any heat. And we can dispense some options wit and or wisdom. Uncle Mike, we're coming into that time of the year where there are many opportunities for some learning, some edumacation. Of course, we're in that mode now, as we touched on at the top of the show, where vol's starting to come off a little bit. People are not exactly hesitant to crush themselves some premium. So perhaps we can talk about that, and trading in a truncated holiday week, or trading in your beloved Apple or XLE, or pretty much whatever floats your boat. What's giving you the spirit here in this holiday season? What do you feel like talking about today, sir?
The 12-month leap knockout collar, of course.
Well, by all means, have at it, sir. Very right. Seasonal and timely.
Absolutely. The 12-month leap knockout collar. What I want to go through today, folks, this is something that I'm going to be adding to a lot of client portfolios. And I've spoken with some of the clients already on it. For those of you that I haven't talked to, feel free to give me a call, or we'll talk about in the coming weeks when we do annual reviews and whatnot. But anyway, what I want to go through, and this is just for one portion of the portfolio, not the whole thing. Let's first do a quick review of the general collar. You buy XYZ stock for $50 a share. You buy the 45 put, And to finance the cost of the 45 put, you sell the 55 call, usually for the same price or around the same price with which you buy the 45 put. Thus, it doesn't cost you anything. You pay for your put protection by giving up your upside, and you have upside from 50 to 55, but you only have downside from 50 to 45. That way, you can get some type of stability, so to speak, within your portfolio, knowing that the most you can lose is the $5. Now, these can be done for any time frame, anywhere from 1 day to several years, depending on the option series that are available. But what I want to go through today is a different version of this that some people call the knockout collar. I call it the modified collar in my book, which is going to be out in a couple weeks, by the way, on Amazon Kindle. We'll have more details coming in the upcoming shows. But anyway, I digress. But let's go through an example that I'm pulling up on my screen right now, just to kind of give you an idea of how this could possibly work. Right now, SPY on my screen, it closed today at 201.67. So with that, the way with which you could do this, and this is honestly what I'm going to be looking at to do over the next couple of weeks with my SPY collaring positions, is step one, buy a December 2016 200 put. Right now I'm showing the midpoint on that to be $15.14. Simultaneously, at the same time, sell a 180 put for December of next year, and we'll just do that for $8.70. So the approximate cost of that trade is going to be a little over $6 when you do the math on it for that put spread. Now, what that does is that actually gives you protection from 200 all the way down to 180. An approximate 10% loss that you can sustain in the S&P, and the cost of that protection is going to be a little over $6. Now, how are we going to pay for that? Well, a couple of ways with which you can look at it. One thing that Alex Jacobson often said on the show was that the reason that people do collars is that they don't want to pay for the put. Do people really want to sell the call when they do a covered call, or sell the stock when they do a covered call? And a lot of times the answer is no. You want to keep riding it up. The only reason you mess with the covered call on it is because you don't want to pay for the put. But here's some things with which to think about. SPY pays an annual dividend of around $4, between $3, just depending on what they end up doing next year. But let's just assume it's around $4. Would you agree, Mark, that around 2% seems like a fair estimate of what the S&P will pay next year?
Sounds fair to me, sir.
All right. So for that $4 with which it will pay, that's going to cover about 2/3 of the cost of your downside protection right there. So now what you have is a way with which you're giving up 1% in terms of cost, because the dividends themselves are going to finance the cost of the approximate $6. And I know I'm kind of messing with the numbers a little bit, but I'm just trying to give you an idea of this. You're giving up approximately 1% to have protection on the first 10% of the downside. Not exactly a bad deal. But wait, there's more. Let's say that we want to do a few things with this. Let's say that we want to get a little bit of income on it. We can sell covered calls week in, week out. We can do kind of a modified wheel trade. Let's say that we wanted to sell the 230 covered call on SPY. You can get, ironically, $2.30 is the bid on the 230 covered call on SPY for that same time frame. So that's another way with which you can finance it. What I'm looking to do personally for my clients next year as a way of financing this put spread is selling a call spread. Now, here's the reason with which I'll do it. And let me give you the first way with which to do it. And for the most part, folks, this would make the math a lot easier if SPY would have closed right at 200 today. Unfortunately, it did not. So we're going to do a little bit of rounding. I'm just trying to get the concept through right now. Let's say that I sell the 220 call on SPY. That gives me nearly 10% of upside. I sell that for $5.25. That's the midpoint that I'm showing on my screen right now. With that, I also buy a 240 call for, I'm showing 87 cents. So for $4.50, I actually get a credit or for giving up, for selling that call spread, I get a credit that could also help finance that put spread with which I bought. So now, if you want to include the dividend and the credit from the call spread with which I sold, I'm net positive on the year in terms of income, assuming the dividend is still paid, which I think it's very likely it will, but of course dividends are never guaranteed. Just want to make that disclosure. So now here comes the age-old question. What do I do if the stock goes up? What do I do if the stock goes down? What do I do if the stock stays the same? That's something you need to ask yourself before any trade. Well, if the stock stays the same, you're going to get a very minuscule credit on the year. And if you take absolutely no action, then nothing will happen, quite honestly, except for the minuscule credit that you'll get. But that's fine. If the market stays the same, if you're fine staying the same, nothing wrong with that at all. What if the market goes up? Well, that's when you need to make a decision. Do you do nothing and then just give up the second 10% of your market rate of return? I don't know. That's a question for you, the individual trader, to ask. I have my goals and my thoughts for what to do if that happens for my clients in terms of rolling up covered calls or when to take action, when not to take action. I've gone through that a lot on this show, so I don't want to belabor the points and relive or reteach what we've talked about in those situations in today's segment. But let's just say that you decide to do nothing, which could be perfectly fine. If the market goes from 201.67 to 220, well, hey, you got to experience all of it anyway, and you had some protection. That's great. Market goes up to 240, and you have an approximate 20% gain on the year. You'll get a 10% gain. That's what you're giving up. But the reason that you can buy by buying that extra call on the upside, let's say we have a 30% gain to the upside, then you're still experiencing 20 of the 30% because of the fact that you capped off and sold a call spread instead of a covered call. Now, let me give you the reason for the method to the madness on this and why I think this is something that's worth exploring. There is an inverse volatility skew a volatility skew to the downside on put options. So, for example, the 200 leap put with which I'm discussing right now, the implied volatility on that one is 18.24%. And I'm getting this from the Thinkorswim volatility model. So take that for what it's worth. This will give you a general idea, though. The 180 put has an implied volatility of 21.77%. So you're selling something with a higher volatility than what you're actually buying. That's one thing that can be very attractive about this strategy. Now, on the flip side, let's take a look at the call options. Call options, I sell the 520 call in this time frame, not the 520, the 220 call, that has an implied volatility of 16.04%. The 240 has an implied volatility of 12.95%. So this call spread with which I'm selling something with a higher implied volatility than what I am buying. Bottom line is that you're doing a good thing with this four-legged knockout collar call spread hedge as we're doing this. So we've talked about what if the market stays the same. We've talked about what if the market goes higher. Now, what if the market goes lower? I've said on this show many times that as the market goes lower, a lot of times implied volatility goes up. There's nothing earth-shattering there with the inverse relationship between implied volatility and market performance. But what that does is that enables you to roll down puts and makes it not quite as hard to do. So let's say that the market goes down to 182, 184, 180, whatever you want to make your mark at. Well, if that's the case, what you could do is roll down the 180 put from 180 to 170, extend your protection a little bit, or all the way to 160, depending on what the market gives you. That's one way with which to do it. Now, the other thing with which you can do at that same time frame is as the market goes down, it's very likely that your short call will lose a lot of value in it, which that part of it's a good thing. So the concern that I always have whenever I'm rolling down a put or taking some type of protective action is always, well, Murphy's Law dictates that the market's going to snap back the second I do it. It happens to almost everybody at one point or another. Here's the advantage of setting it up with this strategy. By getting out of that 220 call for 90 cents or something along those lines, you're getting approximately 80% of the profit that you wanted to get to begin with. And I'm under the assumption that this all happens the first day, just so you know, so to make this a little bit easier. Now, let's say you roll down that put and the market snaps right back to where it originally was. You can sell the call spread again. And at that stage, you've taken on some income again, and you've extended your protection from 10% to 15 or 20%, depending on where you rolled. So with this is one to where initially it appears to be a very passive strategy doing this with leaps, but it can become a very active strategy. And this is something that I'm not going to do the exact methodology with which I just described for my clients next year, but because of the fact that I love the option block and I love the listeners so much, this is something that I wanted to share with everybody because this is something I think can be very valid in 2016. So with that, I turn it back over to you, my good man, Mark.
Well done, sir, as always. And now let's keep on rolling with the program into the mail block.
It's time to take your seat on the All-Star panel as we read your emails, tweets, Facebook messages, website comments, and much more. It's time for the Mail Block.
You guys know I'd feel bad since this is our only show of this week. We only have one more next week before the end of the year. I want to make sure I at least give you guys a little bit of time on the show today because we're not going to have our big listener mail extravaganza like we usually do on Thursday. Let's kick it off here with a quickie here from 7777. He writes, hey, is there a specific reason open interest in SPY puts has big clusters at the even strikes? And, you know, this is a common phenomenon. We see this not just in options, but pretty much across the board. If you go and look at, you know, the order books for big listed stock, you'll see buy and sell orders clustered around even price levels and things like that. This is really just the way the human mind works. That's where we work your orders. You know, if you have XYZ stock, it's trading at 93 or whatever. Where are you going to work your sell order? Probably in 95 or 100 or something like that, you know, or some other even strike interval in that range. You're very rarely going to come in and say, I'm going to work my stock order at 97.38. It happens, but it's not very frequent. And so the net effect of that in aggregate is to see these big clusters of open interest around these, you know, strikes that people can wrap their heads around, that systems and programs can wrap their heads around as well very easily. And so this is kind of just a human failing, if you will. Who knows with the prevalence? I'm making up words here. Who knows with the proliferation of algos and bots out there in the universe? They don't have those same concerns that we do. So and they don't have the same psychological needs to work their orders at open levels and at even levels. So who knows? We might see more strikes and clusterings of open interest around different, more esoteric strikes in the future. There might be something interesting to keep an eye on. But for now, while humans are still driving the lion's share of the flow, it's going to be even strikes. Anything to add there, Uncle Mike? And do you work most of your orders around some even and reasonably intelligible level, or do you go out there offering your stock at 97.38 and all that fun stuff?
Oh, I'm a 97.38 kind of guy, just to be obnoxious. No, I agree. It is how the human mind works. A lot of people have things around that level. I typically go by percentages. So if like the stock is at 94.67, I will take a 10% drop from there, and then that might be where I would place a stop loss. So I'm typically more along those lines, but it is very common to do it right at those even levels. You'll see it all the time. Just even as I'm looking at doing from the last segment, I'm just looking at the leaps. 44,000 for the 210 put for December 2016, 3,000 for the 215s, 1,000 or 1,200 for the 220s, but then 225, it's up to 11,000 again. And so you're absolutely right. It's very much how the human mind works. And I typically try and go percentage based on the underlying for my clients and myself.
Yep, we're all creatures of habit at the end of the day, and we tend to like our nice, safe, even round number strikes. It's just the way the brain works. So good question there, Mr. or Mrs. 777. That's going to have to do it for the listener mail today. As we keep on rolling into our final segment, it's time for Around the Block.
It's time to tell you what we'll be watching on our trading screens until the next episode. It's time for Around the Block.
All right, like the man said, this is the portion of the show where we tell you what we're watching and keeping an eye out for in this truncated holiday week. And despite the fact that it is a truncated week, still got some stuff to keep an eye on, including some earnings coming out to the holiday week. You don't see too many big names coming out this time of year, but Nike and Micron deciding they're going to buck the trend. So keep an eye out for those. They're coming out in the next couple of sessions here. And so at least if you're a diehard earnings watcher, earnings player, still a few names for you to keep an eye on. We also have Micron on two. Yes, Nike and Micron. Nikon made a new company. At least an old school company that's not really doing that well these days. That's a conversation for another day as we talk about, Tuesday seems to be the big name for them along with Conagra Foods and everyone's favorite Paychex. And then we also have some numbers coming out this week in terms of GDP and durable goods and new home sales and consumer sentiment and, of course, jobless claims. So there is a little bit kicking off this week, even though it is a truncated week. Markets, of course, closed on Friday for Christmas and a short day on Thursday for Christmas Eve. So all of that said, let's kick things off in the land of the pit by way of Detroit. Mr. Greasy Meatball, what are you keeping an eye on for the rest of this holiday trading week, sir?
I think the key is tomorrow. If we get more follow through, I think you can see a explosion of proportions we have not seen in months, and we could see the VIX break 16 potentially. Keep an eye on oil. Keep an eye on the oil names, and really, I'll be interested to see whether they're able to get S&P up on the year because they want to. So I'm going to be watching to see if we have if it's rally ho ho ho. In the S&P and rally no in the VIX.
All right, and thank you for that. And now turning our attention a little bit closer to home to that lovely paradise on earth known as St. Charles, Illinois. Uncle Mike, what are you watching for the rest of this holiday week, sir?
Just to add to what Mark said, I think it's trying to see if we can get the S&P to be positive on the year. It's down by about 1.5% at this point as I'm looking at it. So I think that 205 half on SPY is a really big number, and I think it'll be interesting to see if we can go positive on the year with the movement that we've had in December. It wouldn't surprise me if we had a really big rally or just kind of sat here.
There you go, sir. We'll keep an eye on that. We'll see if the VIX implosion continues. We'll see if the rally continues as this holiday week continues. The only thing that won't be continuing, unfortunately, is this program, at least for the rest of this week. This is our only episode for the week, so this will have to do. But don't worry, we won't keep your feeds empty. Hopefully you liked that little taste of the best of last week. We're going to give you a little bit more of that later this week as we dig through the multi-year history of this program to find some gems and goodies for your earlobes there this holiday season. But before we go, as always, let's check back in one more time with my cohorts here on the old program to see what's cooking in their necks of the woods, starting with you, senior greasiest of greasy meatballs.
We're going to be doing a webinar next week. Keep an eye on your mail. Keep an eye out for an email invite from me. We'll do it sometime during the week next week, and it'll be a great time.
All right, thank you for that, sir. I wouldn't have put that quite in those same terms, perhaps a little bit less with the blue language and the swearing, but that's your prerogative, as always, sir, of course. No, I'm teasing Mark. We had to pre-record that, so we'll just give him a little bit of nudge as we move on to our final contributor here. Uncle Mike, what is cooking? What is coming off? What is firing off? What is coming down the pike in the land of RCM Wealth Advisors?
Hey, the big thing that we have coming on Kindle at the beginning of the year, probably January 3rd is what I'm shooting for the release of the second edition of Go Long, New Option Strategies for Buy and Hold Investors. Check it out. I will have more information on downloading it in the next show.
There you go. The much awaited, much anticipated, much ballyhooed return of Go Long, perhaps with a new forward, new intro by good old Uncle Mike and some new revisions here for 2016. If you're an old school listener to the program, you remember when that book first came out, then it got caught up in some of the industry tumult that has happened since then, but now it's back and ready to be eagerly devoured by our listeners. And on behalf of Uncle Mike and the Rock Lobster, and actually not the Rock Lobster, the Greasy Meatball, and indeed myself. I want to thank all of you out there in the listening audience for downloading, streaming, and subscribing to the show. And of course, hope everyone out there has a great and safe holiday season. We'll see you back here next week for more of the Option Block.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.